Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are up 1% on the 1 hour chart. We are currently at oversold RSI, and if we expand out to the 4 hour chart, we were oversold on Wednesday and Thursday, and right now we converge on the MACD. We also see a convergence on the 9 moving average and the 18-day moving average. On the daily chart, we do see the trend line still intact, so let me draw it for you. So this trend line started back in late April or early June, and this we are still maintaining above it. We have not closed below this trend line, so that's a good indication that this uptrend is still intact. However, if this trend does fail and break down lower, the next support is this 200-day moving average, and that also coincides with past support from August all the way to late August. So I'll mark that as our near-term support, and at the price of $283.60. However, if we do continue to move on higher, the next resistance is this 9-day moving average, which we are very close to, and that 9-day moving average also coincides with past resistance that we had during the month of August. So as of now, we need to see the candlestick close above it and maintain above the price of $294 for several days to clearly see that this trend can continue to move on higher and break new highs. So if we were to move on higher to touch the 9-day moving average resistance, that is roughly around 12 basis points, not much. We are very close to the resistance. However, if we were to break this trend line and touch the 200-day moving average, it is around 3.4% move down. So let's head to the forecast model. On here, I'll go day by day, where the S&P 500 will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecast models we should focus on? Ideally, the model that is the best match to the current trend. This is the current trend, and below it is the trend that I believe is the best match, and this dates back to October 2nd, 2012 to December 31st, 2012. So let me point out why these two charts are similar. So what we have in the beginning, we started off above the middle Bollinger Band, and then we proceeded to head down lower to touch the bottom Bollinger Band right there, and then finally we made a very nice reversal. However, this reversal is only temporary. We touch the upper Bollinger Band, and then once more touch the bottom Bollinger Band the second time, and then we see right here an attempt to touch the middle Bollinger Band or revert back to the mean. So we see those patterns, and right below it is a trend that we start to see similar patterns touching the upper Bollinger Band or averaging above the middle Bollinger Band. So let's just mark all the instances where it touches the upper Bollinger Band. So we have 2 there. Let's mark where it touches the bottom Bollinger Band, and finally once more right towards the end, and also right towards the end is where we reverted back to the mean to touch the middle Bollinger Band right there. So we have about 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe if this trend is similar, there is reason to believe the outcome and forecast should be fairly the same. And the forecast that we just examined was October 2nd to December 31st, 2012. Back then, the S&P 500 was up around 3.2%, so we may see this downtrend reverse and possibly make new highs in next coming days. So that is it. If you want this forecast model will be available in next coming weeks. Sign up with your email address in the link below. And thank you for watching. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.